Hi, I'm Debra Rudd, and today I'm going to talk about the myth of the 3-year rule in pre-expatriation gifts. Everything I'm talking about today applies to expatriates. Expatriates are either U.S. citizens who give up their citizenship or U.S. green card holders, also known as lawful permanent residents, who give up their green cards after having the green card during 8 of the last years. So for citizens, it's just a status change. You're a citizen and then you're not. For green card holders, it's having the green card during 8 calendar years and then giving it up. So it's a time requirement plus the status change. And that's what makes you an expatriate for green card holders. If you're a green card holder and you did not have it for the requisite length of time, then when you give up the green card, you're not an expatriate. Now, the main thing that we're interested in when we're talking about expatriates is exit tax. And there's 2 types of expatriates, covered and non-covered. And only covered expatriates pay exit tax. You're covered if you fail any one of these 3 tests. If your net worth is over $2 million, you're a covered expatriate. If you have a high enough 5-year average tax liability, for 2025, the number is $206,000, and that's indexed for inflation every year. So in 2025, if you expatriate and you look at the prior 5 years tax liability, you add it up, divided by 5, and it's $206,000 or more, then you're a covered expatriate. Or if you didn't file tax returns or pay taxes for the 5 years before your expatriation year, then you're a covered expatriate. So you fail any one of those 3 and you're covered. But if you don't fail any one of those 3, then you're non-covered and you're not dealing with exit tax. When we're talking about exit tax, there is one main rule that applies to everything, and that's there is a deemed sale of all the property that would be included in your gross estate if you had died on the day before expatriation. The deemed sale rule comes from Section 877 Cap A, little a, and the note about what would be included in your gross estate is the stuff that's subject to the deemed sale, and the exit tax, that comes from Notice 2009-85. Now that's the general rule, but for specific types of assets, there are other rules that apply. Deferred compensation items like 401ks and pensions, specified tax-deferred accounts like IRAs, and non-grant or trust interests. The most common planning technique that I see to avoid exit tax is gifts. The general idea is that if your net worth is over $2 million, you can reduce your net worth to below $2 million, avoid covered expatriate status, and avoid having to pay exit tax. The way you do this is by making gifts to human individuals, usually family members, or making gifts to trusts for the benefit of human individuals. Another way you can reduce your net worth is to sell assets you were going to sell anyway, like your house in the US, for example, and pay tax on the gains. And that reduces your net worth maybe enough to avoid covered expatriate status. Or maybe that combined with other strategies reduces your net worth enough to avoid covered expatriate status. And for people who can't avoid covered expatriate status, a common planning technique is to give away appreciated assets to reduce their exit tax bill. So most of this relies on gifts. And very often when I'm talking about this, I hear, but wait, what about the 3-year rule? And when people ask this question, they're talking about Section 2035, which, this is not a direct quote, but basically if you give away stuff in which you have retained interest within 3 years of death, that stuff gets brought back into your gross estate. Now, Notice 2009-85 says to pretend you sold everything that would have been part of your gross estate if you had died on the day before expatriation. So the conclusion that I see people making is gifts within 3 years of expatriation don't work, and all the stuff you gave away gets brought back into your pretend estate for exit tax purposes, and therefore it's subject to exit tax. So what I want to do today is take a closer look at Section 2035. And Section 2035 only brings back transfers where the decedent had a retained interest. It points to Section 2036, retained life estate, Section 2037 for reversionary interests, Section 2038 for revocable transfers, and Section 2042 for proceeds of life insurance receivable by the estate. So the original conclusion was wrong. Section 2035 doesn't bring all gifts back into the gross estate. Only certain transfers where the decedent retained an interest in the property given away are at risk of estate tax. Most gifts probably do not get clawed back. So pre-expatriation gifts remain a viable planning strategy because Section 2035 will not bring most gifts back into the exit tax calculation. And here are some thoughts about how to do gifts right so that you don't have a problem when you're planning for expatriation. It's a good idea to transfer both beneficial ownership and title. Any transfer paperwork, gift tax returns, etc., all of that needs to be done correctly. The recipient will have full control, and all the rights, benefits, and risks of ownership sit with that person. The transferor no longer has any rights, benefits, or risks of ownership. The recipient reports and pays tax on any income generated by the gifted assets. The donor has no expectation of ever receiving the assets back. There can't be any gift back agreements, written or otherwise. And then lastly, you allow time to pass. That's what memorializes a gift as a real gift. If you give something away and that person still has it 5-10 years later, then that thing was truly given to that person because it was not given back within a month or a year. And just a quick note, it's important if you're making pre-expatriation gifts to look at the gift tax rules that might apply, local transfer taxes, foreign gift or transfer tax as well. So that's it for today. The Section 2035 3-year rule will not claw back most gifts into the exit tax calculation for a covered expatriate. As a general rule, to be safe, don't give things away with any strings attached if you're trying to reduce your net worth. And gifting remains a valid strategy for pre-expatriation planning. Thanks for listening, and here's my contact information. If you have any questions, please shoot me an email. I'd be happy to talk. And just a reminder, this presentation is not legal or tax advice. I don't know the specifics of your situation, and just because you watched this video on YouTube doesn't mean I'm giving advice to you. Please hire someone to help you. Thanks. See you next time.